Inflation erodes purchasing power, while recession slows economic growth. Understanding how these forces interact is crucial for making smart investment choices. Let's dive in. Inflation is simply a rise in the general price level of goods and services in an economy over a period of time. When the price level rises, each unit of currency buys fewer goods and services. Think of it this way. If a loaf of bread cost $1 last year and costs $1.10 this year, that's inflation. This seemingly small increase can have a big impact on your overall spending and investment strategy. Keeping a close eye on these indicators is essential for investors. A recession is a significant decline in economic activity spread across the economy, lasting more than a few months. It's essentially a period of economic contraction where businesses struggle, unemployment rises, and consumer spending slows down. Recessions are a normal part of the business cycle, but they can be quite disruptive. During a recession, businesses often cut back on investment, leading to job losses and reduced consumer spending. As investors, we need to be prepared for these downturns and position our portfolios to weather the storm. Inflation and recession often influence each other, creating a complex economic environment. High inflation can sometimes lead to a recession as central banks raise interest rates to combat rising prices. Sometimes we experience stagflation, where we have both high inflation and slow economic growth. The interplay between inflation and recession can create volatility in the stock market. Understanding these dynamics is essential for making sound investment decisions. Inflation can have a complex and multifaceted impact on stock prices. In the short term, moderate inflation can sometimes boost stock prices as companies raise prices and see increased revenues. However, sustained high inflation can erode purchasing power and squeeze profit margins, ultimately putting downward pressure on stock valuations. When inflation rises, the central bank often increases interest rates to cool down the economy. Predicting the precise impact of inflation on stock prices is challenging, but staying informed and adaptable is key. Recessions typically have a negative impact on stock prices. During economic downturns, consumer spending decreases, business profits decline, and investor confidence wanes. The severity of a recession's impact on stock prices can vary depending on the depth and duration of the economic contraction. While recessions can be daunting, they also create opportunities for savvy investors. By carefully analyzing market conditions and identifying undervalued companies, you can position yourself for future gains. Diversification is a cornerstone of sound investing, especially during turbulent economic times. It involves spreading your investments across different asset classes, sectors, and geographies. This helps to mitigate the impact of any single investment performing poorly. By diversifying your portfolio, you reduce the overall risk. Building a diversified portfolio requires careful planning and consideration of your individual risk tolerance and investment goals. Risk management is essential for protecting your investments during periods of inflation and recession. It involves identifying, assessing, and mitigating potential risks to your portfolio. One key aspect of risk management is setting stop-loss orders. Another important risk management strategy is regularly reviewing and rebalancing your portfolio. Managing risk doesn't mean avoiding risk altogether. It's about taking calculated risks for long-term growth. Maintaining a long-term perspective is crucial for navigating the stock market during periods of inflation and recession. Market downturns are inevitable, but they are also temporary. By focusing on the long term, you can ride out the storm and avoid making impulsive decisions based on short-term market fluctuations. Instead of trying to time the market, focus on building a diversified portfolio of quality investments and holding them for the long term. Remember, time in the market is more important than timing the market. Consumer staples companies produce and sell essential goods that people need regardless of the economic climate. These are things people buy no matter what, making these companies relatively stable during recessions. During inflationary periods, consumer staples companies often have the ability to pass on increased costs to consumers. Investing in consumer staple stocks can provide a degree of stability to your portfolio during times of economic uncertainty. This defensive characteristic makes them a valuable addition to a diversified portfolio. Healthcare is another sector that tends to perform relatively well during periods of inflation and recession. People need healthcare services regardless of the economic climate, making this sector less susceptible to economic downturns. Healthcare companies often have strong pricing power, allowing them to pass on increased costs to consumers. Within the healthcare sector, there are various subsectors to consider, such as pharmaceuticals, biotechnology, medical devices, and healthcare providers. Diversifying your healthcare holdings across these subsectors can further enhance your portfolio's resilience. Section 1. Diversification. Spreading your risk. Diversification is a fundamental principle of investing, especially during economic uncertainty. It's the age-old adage of not putting all your eggs in one basket. Spread investments across different asset classes, sectors, and geographies. This cushions your portfolio against market volatility. Think of your portfolio as a team of athletes. You'd want a mix of athletes with different skills and strengths. Similarly, a diversified portfolio includes a variety of investments. This balance helps to smooth out the bumps in the road. Don't forget to hit that thumbs up button, subscribe, and hit the notification bell. Share this video with your network. Click on the link in the description to subscribe to our free newsletter. Building a diversified portfolio is a personalized process. There's no one-size-fits-all approach. Your ideal portfolio depends on your risk tolerance, investment goals, and time horizon. Are you a young investor with a high tolerance for risk, or are you closer to retirement and seeking to preserve capital? Start by determining your asset allocation. This refers to the percentage of your portfolio allocated to each asset class. A common approach is a mix of stocks and bonds. Consider adding real estate, commodities, and alternative investments. Rebalancing your portfolio periodically is crucial. Remember, at CRAIGTRADER, we're dedicated to helping you achieve financial freedom. Hit that thumbs up button, subscribe to the channel, and hit the notification bell. Rebalancing your portfolio is a crucial strategy, especially during periods of inflation and recession. It involves periodically adjusting your asset allocation to maintain your desired level of risk and return. As market conditions change, some asset classes may outperform others, causing your portfolio to drift away from your target allocation. Rebalancing brings it back in line. Think of it like tending a garden. Some plants may grow faster than others, requiring you to prune them back and give more attention to the slower growing ones. Similarly, rebalancing involves trimming back overweight positions and adding to underweight ones. This helps to maintain a balanced and healthy portfolio. Rebalancing can be done on a set schedule, such as quarterly or annually, or based on market triggers, such as when an asset class deviates from its target allocation by a certain percentage. The frequency and method will depend on your individual circumstances and investment strategy. It's important to have a plan and stick to it. During periods of inflation and recession, rebalancing can be particularly beneficial. It may involve selling assets that have performed well during inflation, such as commodities, and buying assets that have underperformed, such as bonds. This can help you lock in gains and position your portfolio for potential future growth. Value investing is a strategy that focuses on identifying and investing in companies that are trading below their intrinsic value. This means finding companies that are undervalued by the market, offering the potential for significant upside when their true worth is recognized. It's like finding hidden gems in a treasure hunt. During periods of economic downturn, like a recession, many companies' stock prices may decline, creating potential value investing opportunities. Fear and uncertainty can drive down prices even for fundamentally sound companies. This presents a chance for savvy investors to buy low and potentially sell high when the market recovers. Value investing requires careful research and analysis. You need to understand a company's financials, business model, and competitive landscape to determine its intrinsic value. This involves looking beyond short-term market fluctuations and focusing on the long-term prospects of the business. It's about finding value where others may overlook it. Remember to hit that thumbs up button, subscribe to our channel, and hit that notification bell to stay updated. Don't forget to share this video with your network and help spread the knowledge. And for more in-depth tips and alerts, subscribe to our free newsletter using the link in the description below. Dollar cost averaging involves investing a fixed amount regularly, regardless of market price. This helps smooth out market volatility and reduce risk. It's like a steady climb up a mountain. You buy more shares when prices are low, fewer when high. This can lower your average cost per share. It's a disciplined approach to navigate market fluctuations, especially useful during inflation and recession. Avoid the temptation to time the market. Consistently invest regardless of market fluctuations, and investing is a long-term game. Stay disciplined and focused on long-term goals. Build wealth over time with this strategy. At CRAIGTRADER, we're dedicated to helping you achieve financial freedom. Hit that thumbs up button, subscribe to the channel, and hit the notification bell. Share this video with your network. Click on the link in the description to subscribe to our free newsletter. Navigating the stock market during inflation and recession can feel like sailing through a perfect storm. With the right knowledge and strategies, you can weather the storm and emerge stronger. Market downturns are a natural part of the economic cycle. They present both challenges and opportunities. Stay informed, adapt to changing conditions, and maintain a long-term perspective. Don't let short-term fluctuations derail your long-term goals. Build a resilient portfolio with careful planning and diversification. Seek professional advice if needed. At CRAIGTRADER, we're here to help you succeed.